Thank you, Anne, and thanks everyone for being here once again. I know some of you have joined us in the past, and hopefully there will be a few new visitors, new attendees today. And for those that are coming back for more, I'm surprised and impressed. No, I'm just kidding. Thanks for coming back for more charts and graphs, and we like to have some fun here. So we're excited that you're here. This is the COVID-19 market update. I am still David Arbit, as I was a few minutes ago, Mars Director of Research. And so I want to take a moment to thank our sponsors, as we do every week. So we want to give a thanks to Bell Bank Mortgage, North Star MLS, RCU Royal Credit Union, and Supra. And with that, let's keep on chugging. So as we say every week, we hope this finds you and your loved ones safe and healthy and well and staying sane. Also want to point out we have a really top-notch COVID resource page on our website. I just want to point that out. I know I pointed it out in the past, but just want to make sure you guys know about it. There are a whole lot of resources there that'll help you guys do your job better and grow your business and kind of stay in touch with what's happening out there in the market, in the community, and in the policy world. Don't forget about the policy world. Eric does a lot of work in our government affairs section, or sector, I should say, on making sure you guys are up to date on local, regional, state, and national policy changes, trends, guidance, and you name it. So you'll see just a few things from that COVID page here. Our business operations, my local housing market updates. Here's some of Lacey's world here with our education and professional development department. Eric's government responses and all of that activity happens here. You are here. You are in our weekly webinar here. I also, I will at the end as well, but I want to give a shout out to those of you who are on to please check out Eric's webinars as well. So he goes on Mondays at 1 p.m. And he really does a good job discussing, again, all those policy changes. So yes, the market stuff is important, but the policy stuff is important. And you guys staying on top of continuing education is important. And us making sure we get these messages out to you guys in our newsletter and other avenues and channels is also important. A lot of important stuff going on these days, even as we see some challenges and turmoil elsewhere in our community. Okay. Next, data is knowledge and knowledge is power. Therefore, data is power. I know some of you are aware of this or have thought about this before, but I just want to make sure we really fully sort of appreciate that. I feel pretty strongly about data being power and data being empowering. And so it's something that really kind of drives us and surely drives me to kind of keep doing what we're doing. So, speaking of doing what we're doing, today will go as follows. I should say the next hour will go as follows. We're going to talk about the market. We'll show showing activity, buyer activity, seller activity, and we'll continually break this down by price point. So we'll look at different activity in the different price ranges. I will also do a little bit of an economic update, talk about our recovery, a little bit about how the economy is doing, pretty large scale, fairly high level dynamics. And then time permitting, depending on questions and how slow I am to get through some of this riveting content, we will hopefully get time to do a little bit of a InfoSparks demo and go through our market reports a little bit. I can't remember if they were out the last time we did this last Thursday. I think they were, but just in case. No, sorry, they came out Friday, I believe. So I think this is the first session where you guys would be able to see those and where we can talk about them and reflect on them together. Okay. So everything still depends on three major dynamics: the length of this pandemic, the impact of unprecedented levels of stimulus, and then the consumer response or reaction and how that drives spending and behavior. Think of it as a great grand game of tug of war. You've got COVID on one side pulling this way. You've got our government and policy response. You've got our central bank, our Federal Reserve response, and then also don't forget our public health experts and our scientific community. Science is real, and science offers the promise of developing a vaccine and creating some herd immunity and helping us flatten the curve and be aware of modes of transmission and the aerosol, the aerosol dynamic with contagion and all that fun stuff. All right, we won't get too into that, but these are sort of the three, segments of our country that are pulling against the virus, and there's the virus providing or presenting a notable challenge. So please do brace yourselves because data analysis is coming. All right, so let's jump right into the market. So here we are, late May. We've got showing activity tracked all the way back to, well, I suppose not the 1st of January, but the first full week, because remember, this is a rolling weekly average. So looks like Jan 7th, we start with that rolling average for showings. You guys can see the trend. You can also see where the trend unraveled when our whole world changed here in sort of mid-March. You guys can see things leveled off before they kind of declined, once we did the school closure and the state of emergency and whatnot. So we rode that wave down. Let's just do a little bit of timing here. Looks like we kind of hit that peak around what, March 10th or so. Looks like we hit our bottom maybe around April 3rd or so. So, kind of tracking it over time, just about a month from this sort of early March to early April period, sort of a local peak to a local valley. That can sometimes get us down, but look at what's happened lately. I think this is the big takeaway, one of many takeaways, I should say. So what this is saying to us is that showing activity for the year so far in 2020 has reached an all-time high. It is above those previous highs that we saw back in March. This has been a little volatile, not too much, but it has been a little bit noisy. We had the Eastover. Maybe I should just leave it at that, the Eastover. We had the Easter or Passover break here, or as I call it, the Eastover break, or pastor. Anyway, we had a little bit of a Mother's Day break here. And then we've also had a little bit of a Memorial Day break. So this data goes through the 27th, which last time I checked was yesterday. Yep, turns out the 27th is still yesterday. So again, we can see some events impacting our data here a little bit, but overall, this trend is pretty encouraging, I would say. And overall, we have already, once again, reached levels for showings that we haven't seen yet this year. So showing activity has come all the way back and then some, even though it's taken a little bit of a breather. I hope we can. It seems like we can sustain this, but like I said, everything depends on the virus and the course of the pandemic. So showings are mostly back on track. I know I've made a few of these jokes in the past, but I want to bring them up again. Have the health concerns suddenly passed? Well, they seem to have eased, that's for sure. Our 50-year low, if not all-time low, bottom of the barrel interest rates, simply too good to pass up. Well, I mean, I'm sure you guys have been hearing, we've been hearing as well, that rates are pretty enticing, and that is a big motivator for buyers, especially rate-sensitive buyers. And especially when there's some uncertainty. I think people become even more sensitive to rates. In case my spouse, my partner, my cohabitator would unfortunately lose a job, could we still afford these payments with one income? So again, I think rate sensitivity, is a factor these days. Similarly, our buyers, especially first-time buyers, are they taking advantage of less traffic and less competition? As we saw, the showing activity has come down. It's come back up, but are there some buyers who are taking advantage of a little bit of a looser market that's not quite as tight or as competitive? Are the stimulus checks finally doing the trick, the magical trick? Maybe a little bit, maybe less so for others. Are we just getting stir crazy and we need to do something? I know I've said this in the past. Maybe people suddenly need a home with 2 master bedrooms or 4 home offices. Okay, so let's just kind of segment the market into 3, maybe tri-tiles or 3 groupings, 3 categories. We're going to talk affordable, we'll talk luxury, and then sort of that boring middle market, that steady Eddie, consistent, predictable middle market. So when we think about affordable buyers, we think typically younger folks, although definitely not always. A lot of these individuals may be working leisure, hospitality, restaurant, retail jobs. Whether you believe it or not, those folks do buy homes. And a lot of those folks lost their jobs and they can't work from home. So perhaps they're not as likely to buy. Switching over to the luxury side, there's this wealth effect, right? Where luxury buyers are more affected by the stock market. Well, we've also retraced a lot of the declines in the Dow and S&P. We're not all the way back, but let me just say this. Financial markets seem to be more optimistic than the economic data would suggest they ought to be. I guess I'll just leave it at that. Either way, this perceived wealth effect, whether it's a perceived wealthy effect or a less wealthy perceived effect, this can impact confidence spending, buyer-seller activity. I like to give the example, think of someone with a $3 million net worth who had a lot of that in the stock market, and the stock market was down, 20, 25, depending on the segment they were invested in, whether REITs or consumer discretionary or utilities, sometimes it could be down 30%. So think of someone who's worth 3 million, who's now worth 2 million, who does not have 1 million to buy a home in cash. So maybe they finance a 650 or an 850, or maybe they wait, or everyone's situation is different. But I just want to point out that's a possibility in this segment. And then there's the middle market, just salaried professionals who can work from home, maybe growing families with some new household formations. So again, we talked about these losses. So look at the April job losses. A lot of those hit the leisure and hospitality sector. Let's also not dismiss retail, right? Many first-time buyers work retail, leisure, hospitality, obviously some professional and business service jobs as well, and manufacturing and government. Health is an interesting one. I always get questions on this, so let me try to stave them off a bit. We had declines in health because of elective procedures. We are not doing elective procedures, as a lot of that healthcare spend and a lot of those resources are going into fighting the virus. So disproportionate impact here, and a disproportionate impact here, where we see a lot of the March job losses. And I didn't see an update for April, but I'm 99.9% certain it'll be a continuation of this March trend. So we saw a lot of those March job losses hitting folks with a high school degree or less, right? We can really see that. We can see that pretty clearly right here, versus those with an associate's degree, and then versus those with a bachelor's degree or a master's or a PhD or any kind of a certificate. So pretty interesting dynamics here between this and this. It's not hard to see why these buyers could be a little bit more impacted than others. Okay, let's race forward here. So first-time buyers, as we're talking entry-level affordable, I just want to bring this up. 33% of buyers, and this is national, not Minnesota or Twin Cities, 33% of buyers were first-time buyers. So of every 100 home buyers, 33 of those were first-time buyers. You can see how this has come down a little bit as prices have risen. Note when home prices went on sale in 08, 09, and 2010, actually, 40, 45, even 50% of buyers were able to be first-time home buyers. It stands to reason people get a little bit older as they wait to buy a home. Most people age 12 months each year. I think I age about 18 months every year. So 30 years old was the median for this period after the Great Recession. Because again, prices came down, younger buyers were able to afford to buy a home. Prices rose, it became 31. Prices rose further, it became 32. And then most recently, last year, it was 33. So a median age of first-time home buyers at 33 years old tells us half of the first-time buyers are over 33. The other half of first-time buyers are below 33 years old. So here they are, folks, millennials living through their second once-in-a-generation, even once-in-a-lifetime economic collapse, and they're giving each other elbow bumps. Well, at least they're not going out for avocado toast, but can they suddenly afford to buy a house? So this all gives us a theory. If the top and bottom could be softening a little bit, might the middle be performing the best? Well, let's see. So I know in the past we've gone through a little bit more of the historical data. This is kind of one of my only historical data points, well, at least that goes into March. I'll show a few from early May, but we're starting to kind of age out of March and April. But I do want to call your attention just to this. I know some of you have seen this, but some of you haven't. So change in showing activity, same metric for all of these bar graphs here, but here's the kicker. This is for the week ending March 30th versus the week prior. This is for the week ending April 12th versus the week prior, April 19th versus the week prior, and then May 17th versus the week prior. Here's the picture that I want to paint. Here's the picture that the data is painting for us. I suppose I'll help it along. Change in showing activity early on, late March, all segments down, right across the board from under 200,000 to over 1 million, all segments down. The declines were not as bad in some of these middle market ranges, which we'll be talking about. So early on, everything down. Fast forward, maybe about a couple weeks, some segments up, some segments down, some up, some down. So not a clear picture here. This seems to be a little bit of a transitional week. And then for that maybe third week in April, the week ending April 19th versus April 12th, here's where we see all of those robust gains kind of coming into play. You guys will notice these are the, well, it doesn't work as well as I thought. It's like these are the mountains reflecting in the water here. This is almost an inverse pattern. So the ones that were down the most are now the ones that are up the most. We'll be talking about this throughout, but I just want to mention these luxury brackets are pretty thin segments. So if you see, let's say showing activity for million plus went from, 15 to 10, well, that's down 50%. So down 50% sounds like a really big number, and I suppose it is, but that's only from 5 fewer showings, from 15 down to 10. So we'll be talking about that. So everything up in this week, that third week of April, but then as we transition into mid-May, we see much more normal gains, maybe minus some of the luxury bracket activity, which again, I think we can chalk some of that up to small sample size. A little bit of a dip here in 2 to 250, although we saw, a decent gain in some of those, what you might think of as some of these middle market ranges. But even our affordable range, we saw a decent gain for that week. But yeah, most recently, these numbers are much more predictable, much more stable. We're not going to sustain 50%, 90%, even 30% gains, for any long period of time. Up 10%, up 13. Okay, even our luxury segment's doing 30. This is just much more normal, sustainable numbers. Okay, so we just saw this. This is 510 into 517. We can kind of see that change. Let's fast forward one more. So here's our most recent data. And this is actually pretty interesting. So the week ended 525 versus the week ended May 18th. Again, a little bit of a mixed picture here. So some down, some up, couple down, couple up. Looks like our, I think in the past I've called it our affordable luxury segment, or maybe our entry-level luxury segment. Maybe this is entry-level luxury. I don't know. Maybe it's this. This is for sure luxury. So we can see some of these segments doing different things. Down 13, up just under 13. So some interesting dynamics here. Let's also keep in mind, guys, a Memorial Day weekend can sometimes throw things off. A Mother's Day weekend previously can also throw things a little bit. So sometimes when you're looking at weekly numbers, they can be a little volatile, but it's so important for us to track these for you guys, for the media, for members, for the public, everybody. So we can kind of see what's going on in a rapidly changing environment and in a very dynamic environment too. So we've mentioned this previously, but a quick anecdote on showings. We're hearing from some builders that even though showing traffic is down, it still seems to be a higher quality traffic and a more motivated buyer. So maybe some of you were surprised that days on market actually shrank considerably in April. Well, it's a more serious, more motivated buyer. So they're writing better offers sooner. Sellers and seller agents aren't having to sift through a lot of lowball offers and contingencies. And if I sell my home and if the inspection and if I get financing and other things. So maybe that came as a surprise, but when we actually dig in and think about it and sort of peel back the onion a little bit, it does make some sense. It feels like some of the fringe buyers have moved on, some of the looky loons, if you will. I like that, looky loons. All right, so overall showing activity broken down by price range. Shoot, guys, my mom would be upset. Was Mother's Day 5/16 or the 17th? Yeah, I think it was the 17th. So, 17th. So that week, we could see a little bit of a pullback, perhaps versus the prior week, but not really. We're seeing gains in most segments, maybe perhaps this 2 to 250 range. Let's fast forward one more. Here's our most recent number. So this one, I think because of the holiday weekend, we do see a little bit of a decline in our most affordable segment. Actually, a little bit of an uptick where we were down the week prior in that 2 to 250 segment. But then a little bit of a dip pretty much across the board, minus maybe this first move up market versus the second move up, if you will. A little bit of a decline in 800 up to $1 million, and a little bit of a jump in over $1 million. So let's also think about the share. It's one thing to say this or that rose or declined, but what about the share of the overall pie? So what we can say here is, let's see, just under 1 in 4 showings occurred on homes under 200,000. A little over 1 in 5 showings was on homes between 250 and 300,000, and so on. A little more than 1 in 10 was for homes priced between 400,000 and $500,000, and then about 1.25%. So, about what, 12 out of 1,000 or 1.2 out of 100 were on listings over $1 million. So more recently, so that was week ended 5/17. This is week ended 5/25. Again, we see million plus from 1.2 up to 1.5. We see this one shrink a little bit from 1.5 down to 1.3. Let's go over to our affordable end, 23.3 down to 22.6. Let's see, 19.6 and 26 versus 18.6 and 21.9. So you see little, you see little shifts in the share of some of these, but I don't think I'd say anything major to write home about, especially given a holiday weekend that can throw some numbers a little bit. Okay. Let's talk for just a moment about the life cycle of a listing. So first, a listing is new, and then it's active. I know that just blew your minds, mine too. First, a buyer gets pre-approved, and then they go to showings. Hopefully, eventually, they'll sign a contract, and it'll become one of these new or active listings will become a pending sale under contract. And then eventually, the vast majority of those will, of course, become closed sales, where we get all the data, price, right, ratio of sold to list price, everything else that comes with our data. Alrighty, transitioning into our weekly report here. This is right on our homepage at mplsrealtor.com. You guys will see most of our major metrics that we track weekly in our weekly report. So this one shows current year 2020 activity in blue versus 2019 activity in dashed gray. Some interesting movement here. It looks like that Mother's Day weekend. Gosh, I have this weird feeling that I'm getting this wrong. Week ended 17th. Yeah, so maybe Mother's Day wouldn't have affected this too much, but we did see some nice recovery in new listings. We didn't quite get back to our high for the year that we saw in early March, but we did recover nicely. We have taken a little bit of a breather since. This will show up in some other numbers, guys, so just kind of keep this in mind. It is okay to take a breather on your way up, right? That is okay. Nothing goes straight up or straight down forever. Tell that to Elon Musk. Pending sales, again, switching gears to the demand side of our equation. Look at current activity, guys. So the buyer side of the equation, the signed contracts with listings with accepted offers, this is, it's encouraging for now until they hit the inventory wall where we don't have enough supply for them. And then I think they're going to get frustrated. And, I think they'll still be motivated and committed, but it's hard to drive sales activity higher if we can't resupply the inventory bins, so to speak. So, I know our supply crunch has really held back some of our demand indicators, even though we have gotten back to all-time highs in terms of unit sales. We've come down just a little bit, even pre-COVID, and we believe that has a lot to do with the supply shortage. So I'll say it again, buyers, stomping higher with signed contracts, 1 week, 2 weeks, 3 weeks, 4 consecutive weeks now, after sort of bottoming out, I guess, at least for the time being, likely for the year, but all we can say is for the time being for sure. We've seen many consecutive weeks of gains. And actually look at how much we're starting to close this gap with the previous year, with the 2019 trend. You guys can kind of see when things crossed. You can also see how on both the seller side and the buyer side, we were trending ahead of 2019 for sellers and for buyers. I like to point out this has a lot to do with the weather in 2019. We had a lot of snow and then a lot of melt. So maybe that shouldn't come as a surprise, but this is still encouraging because even after the snow melted last year, we're still seeing that we're starting to compete with last year's numbers. We're starting to go back there. Okay, so this is new listings. Some of you have seen this one, even though I update it every day and every week. This shows new listings. It's kind of a rolling daily, it's a daily new listing count, but we use a rolling weekly average just to smooth out the numbers a little bit. Here we can see 2020 in black. We can see a nice recovery since we hit that low in maybe early to mid-April. Things were looking pretty encouraging. And then again, we've taken a little bit of a breather. Please do note, this has happened in past years as well. A lot of sellers come on and, after the Super Bowl in Feb, so you kind of see this push at the beginning of Feb, here's this push, and then, kind of flatten out a little bit into the end of the month. Here's March, we see this surge, and then kind of flatten out. Here's April. Again, we see this surge, at least in past years we have, not so much for this year, and we know why. And then again, hitting early May, we see this surge, I suppose, in some trend lines, not others. And then it's not uncommon to see a little bit of a cool down here. Some of that could be with time of year, some of that could be time of month, some of that could be holiday, and several other reasons. So we have been able to sustain this trend, not quite this growth trend, but at least this trend is still intact. So I still think this is encouraging. I still don't believe that we'll sort of retest these lows or fall below them. I suppose it's possible. I don't believe it's likely. Yes, pendings. So as we discussed previously, this is where a lot of the strength is. It's on the contract side. It's on the buyer side. So look at this, guys. Pending sales kind of hitting their peak in mid-March. Well, more or less their peak for the year so far. Bottoming out mid-April. So sometimes I've actually, this is kind of remarkable. Things started to decline here, March, 15th, 16th. We hit bottom, April 15th, 16th. It was almost a month to the day from sort of peak to valley, which I thought was pretty interesting. We are not yet fully caught up, but you guys can see we are getting really close. Really, really close. So, for buyers, for signed contracts, this trend, I think, is still pretty much intact, depending on what happens here. But again, even in past months, it's not uncommon to see, some volatility and some dips, depending on the month and the time of year and whatnot. So just to really drive this home, buyers seem more motivated than sellers. And we've been seeing that for a while. That's why inventory's been so tight. Buyer activity has been really strong. Low rates have a lot to do with that, but sellers have still been a little bit reluctant. Where are they going to go? It's a game of musical chairs. Where do I sit down? What roof do I have over my head once I sell my roof? And so, and with affordability, maybe some sellers like their payments, even though maybe they want another 500 or 1,000 more square feet. it's tough to find it in the places where they want to be, close to jobs, close to work, close to dining and nightlife, if that's your style, close to schools or aging parents or what have you. So buyers have been really pretty relentless since things started turning around here. Sellers not quite as much, but maybe we shouldn't be surprised by that. Alrighty, so as we've done in the past, I've advanced this another week where we can look at the week ended, so pretty much this week ending mid-May of last year versus this week ending mid-May of this year. Change in new listings by price range. So this is seller activity, and we're tracking year over year change by week. So just keep in mind, this is weekly. We will look at year over year change by month coming up very shortly. So here, a lot of the losses in seller activity, a lot of the losses in new listings seem to hit this 150 up to 190 or maybe 150 up to 200 range. Seller activity down 51%. It's actually even in under 120,000. It's not a big number though of activity that we see under there. So to the extent that, buyers are absorbing this product off the market, it's really hard for sellers to replenish it. I mean, builders can't really play in that environment. It's hard. Hey, anyone can live in whatever product they want, wherever they want. But if you have a growing family, it's hard to think about, a one-bedroom condo in this price point or something like that. So as we kind of move up the price ladder, we actually see the slightest declines. The smallest declines came by way of $750,000 up to $1 million. And then even over $1 million, 16, 17% decline, not huge. And that means about 27% overall. How about on the pending sales side? So notice for sellers, we had no gains, no gains. On the buyer side, oddly enough, we actually had a gain in $1 million plus, but remember this was down a lot previously. And then we actually had a gain in one of these maybe affordable, or I suppose you might call it a middle market segment. So 250K up to 350K. We actually had a 5%, nearly 5% gain in signed contracts. Again, pretty sharp declines in that very affordable segment. But let's also notice, guys, 5, 10%. Oops. Oh, now I've done it. 5, 10%. Look at new listings. Nothing was down 5 to 10%. Everything was over 10%. Many were over 20 or even 30%. Not the case on the buyer side. Interesting divergence here. We see a fairly sharp pullback, over a third decline for 3/4 up to $1 million versus a 25% a quarter gain for $1 million plus. So, sometimes these move in the same direction, sometimes they don't. All right. Kind of wanted to try something new. Every time PowerPoint suggests these design things, I usually get annoyed by it and say, just stop talking to me about your design suggestions. But I decided to take one because I think we need a little bit of pretty slides. We need some prettiness in this world right now. Yay. Okay. That was a bit out of character, but here we are. So change in new listings by price range, you guys. This is for March. Please do note, we saw some gains in new listings in March. A lot of those came by way of the middle market. So call it, I'm going to round here a little bit, call it 200,000. I don't know, maybe up to 5. I suppose maybe up to 750. But remember, the bulk of this occurs in, what should we call it? Maybe 250 up to 4, maybe 250 up to 450 or so, where we saw the biggest gains. And overall, that was about an 18% gain in new listings. All right, so sticking on March, here we have pendings. So again, we see the largest gains in mostly those middle market segments. Okay, before we transition to April, viewer discretion is advised. Darn it, I did it again, didn't I? I'm sorry, guys. I really meant to. I really thought I changed that. So you're going to see a little bit of the sausage making here. Let's just make that guy appear. And I bet I did it. Oh, no, looks like I actually might have done that one right. So let's make sure that appears. Let's get back into our presentation. All right, forgive me. So April, here's April monthly, and we can see where a lot of our declines happened, right? A lot of our declines were affordable and luxury. So here again, our theory seems to be playing out a little bit with our mid-market ranges performing the best, or I should catch myself and say the least bad, right? I suppose you could call it the strongest performance. Even the strongest performer was still negative. So we did see better performance in these middle market ranges. On the seller side, let's just do our quick trick just to look at the volume, you guys. This is the unit volume. So, where we were down, about 7%. Well, that accounts for 1,600, 1,500 listings most recently. So what is this? 110 fewer new listings, made up a 7% decline. Here, 185 down to, call it 105. So 80 fewer new listings. Well, that's a 43% decline. So just know that you'll see more dramatic change in our thinner segment. So think of it as small sample size. Here too, guys, just make the math easy on yourselves. 140 down to about 70 would be a 50% decline. Well, we were at about 45%, but again, this is a thin market with, small sample size. All right, let's keep trucking. We got some other fun stuff to get to. Pending sales followed a pretty similar trend. We saw fairly notable declines in affordable. I guess one notable decline in our second move up or our early entry level luxury segment. Sometimes I think the names we come up for these ranges, the names we come up with can be humorous. And overall, just shy of a 20% decline in pending. So new listings down about 21, pending sales down about 19.25. Not a huge difference. Again, we see our middle market theory playing out. And here again, million plus, from 66 down to 55. Well, 11 fewer signed contracts. Well, that's about a 17% decline. Oddly enough, we were dead even, 88 to 88 signed contracts for a 0% change in 750 up to a million. Here again, about 115 down to about 75 accounted for about a 35% decline. Okay, quick time check here. Let's just see where we're at. And I see 238. So let's transition. Yeah, let's transition a little bit, guys. Let's look at our reports because, as I said, we have April numbers out. So I want to just take a moment to show you guys how that kind of looked. So let's bring this in. And yes, I think I even already have that loaded. Well, just in case, I want to show you guys how to get there. Lots of different ways to get there. Market data. You guys can also find some links here. And then we've got a link to InfoSparks, which is inside of Matrix, which we'll talk about. So I'll just click these local market updates and you guys will see it'll take me right to that page that I've already got here. Monthly indicators, well and good, right? April numbers. There again is our 22. Well, remember, I've actually got refreshed numbers. So the data we just saw reflects some more recent status changes for new and under contract deals. So we're actually seeing better numbers and more recent numbers than this. But again, down about 20% for both. So that's kind of where the numbers come from. But actually, we're still up year to date, up about 1.5%, 1% and a third, roughly. Some people are still surprised by this. Median sales price, stomped 9% higher, first time ever over 305,000. You guys want to look at the trend on that? There you go. Make it a little bigger. Median sales price, even in the bubble, 2006, right? We did not surpass 250,000. Here we are, 2020. First time we're over this trend line, this grid line, and that's the 300,000 mark. So we are above 300,000 for the first time ever. Sometimes you have to be careful with this. The media likes to pick up on that. And, there's nothing wrong with saying, home prices reached an all-time high in the midst of a pandemic. But I don't know, sometimes the optics on that, it sounds funny, but it's true. And that's because deals that closed in April, remember, of course, were for contracts entered into, signed in maybe February, early March, maybe even late March. So some of it was before a lot of this, a lot of this was pre-COVID, kind of before everything changed. So just want to point that out. I also want to point out we have our local market updates out as well. So from that same link, instead of monthly indicators or our weekly report here, by the way, that's where we looked at some of our weekly charts and graphs from this weekly report. I know that this is where you guys spend most of your time because as great as the monthly indicators are, they look at the whole Twin Cities region. Well, not only is every neighborhood, city, and zip code and school district unique, also every different market segment is unique, which is why we're going to get into InfoSparks in a moment. So let's do Hennepin County. Now you'll see all the cities within Hennepin County: Brooklyn Park, Maple Grove, Plymouth, Tonka, Into, Edina, and Richfield. Oh, what should we check out today? Maybe let's check out Champlin. How are things doing up there? I think Jeff Kendall's been on this call in the past, and I know he, a lot of his team does some activities in the Champlin Ice Forum up there, and they love that pizza ranch up there. Champlin, new listings down 40%. Closed sales only down 16, prices up about 8.5% to 293, a little over 293. 1.3 months of supply, very tight market there. Days on market. So here, actually, interestingly, days on market rose in April, even though they're down for the last 12 months. So pretty interesting divergence there. My bet is we're going to mostly show days on market declining. So here we have days on market declining almost 30% from 21 to 15 days in Richfield. So days on market, 15 days, pretty quick, 2 weeks, pretty quick. Didn't we just say 1.3 months of supply was a tight market? How about 0.9 months of supply? Less than 1 month of supply here. Richfield is a very competitive market. Some folks who don't like the tax situation in South Minneapolis or what have you, some of those folks have chosen to look at Richfield. I suppose I should add, well before recent events. Let's do one more here, guys, before we jump elsewhere. Yeah, let's do St. Louis Park. I know that's been a pretty hot market lately, and let's just check it out. So yeah, new listings down about 19%. That's pretty consistent. Closings, wow, up 30%, but only from 20 more closings. Prices, median sales price, St. Louis Park, $333,000. Many of you remember a time not all that long ago when homes in St. Louis Park cost 180 grand, and they are just about, maybe later this year or next, they could be about double that, from 180 to 360. So this has really been one of our hotter markets. All right, enough of that. Let's pivot into InfoSparks quickly before we kind of get back. So when you guys are here in the matrix, I've already clicked on and off it a million times. You'll see InfoSparks. You'll see the InfoSparks link there. You'll also see an InfoSparks link there. Let's just look at a new listing really quick. It'll be fun if I chose one of yours. Hey, here's Champlin. Let's pick on Champlin again. You guys will also see an InfoSparks link here. So a lot of different ways to sort of access the tool. Oh, hey, look, I was already comparing Golden Valley and St. Louis Park. Oh, days on market, 13 versus 12 days. Yeah, kind of interesting. So let me close out of that. Here's what you guys will be looking at for the most part when you get into the default, sort of the default view of InfoSparks. Shame on me. Let me make this bigger for you guys. Sorry. I've got aging eyes here, my own. So yeah, days on market 17, down 19% for April, right? For April. You know, there's virtually nothing that we can't do here. There's our 305, there's our plus 9%. There's that 305 up over 300,000 for the first time in our history. You know, we can look at everything. There's our new listings down about 21%. There's our pendings down about 20%. You guys can kind of see just how much the head of that trend line has sort of been chopped off. You know, it's not uncommon, if you actually look back here, it's not uncommon to, you know, have a little bit of a dip in the spring market as we get into summer. But remember, these are pending sales. These are signed contracts, which happen before closed sales. So as you can see, we haven't really seen that impact to closed deals yet. In fact, there we have about a 4.2% gain. And again, not seeing a pullback here yet, but look at pendings. Pendings, we do see a pullback. Remember what we discussed about that life cycle of a listing. The vast majority of pending sales become closed sales. That means pending sales are a pretty darn reliable indicator, a pretty reliable leading indicator of closed sales. So As go pending sales, so go closed sales. At least they tend to. It's never a one-to-one relationship. It's never perfect. Nothing is. Aren't we learning that these days? But there is a pretty close relationship where changes in pending sales typically trickle through to changes in closed sales. So, gosh, you guys, there's so much we can do here. I don't even know where to begin. Let's break things down. I know we did this last time. Let's break things down a little bit by property type for us. Let's look at new listings. And you know what? For this, I'm actually going to do a quick change here. You know, the line chart is well and good, and it's nice to have these little data points off there, off to the side. I want to do bar charts here. It just makes more sense to me. I think it'll make more sense to you, but by all means, you guys do what floats your boat and whatever works for you in your business and in your style. So here we have it. Single family new listings, only down about 20%. Condo new listings down 39%. Townhome new listings actually the smallest decline of 18.6%. Let's shift over to pendings. Single family down about 14%. Condos we see here down almost 50% on signed contracts. You know, there's no way to be sure without interviewing a statistically significant cross-section of those buyers. But I will say it seems likely, it seems intuitive that some of the health concerns around buildings with shared spaces and a lot of common spaces, you know, a lot of the health concerns seem to be holding some people back from this segment. Overall, it's a tight segment. It's a thriving segment. People like living in the city. I don't think that'll change. I just think we're going through a little bit of a disruption, a little bit of a hiccup. We'll get a little more into that. Townhome signed contracts somewhere in between, down about 30%, so between 50 and 14 or so. Yeah, I suppose let's just take a look at closed deals. Single family closed deals in April rallied 11%, right? And that's at least at a 3-year high. Condos down about 33, and then townhomes again down just about 5%. So single family, the best performer, townhomes, the smallest decline. Again, condos seem to be the hardest hit. Okay, now let's look at construction types. I know the vast majority of our region is previously owned homes. You know, just looking at the numbers over here, or I suppose here, all right, so 4,000 plus about 500, that's 4,500 total, and 4,000 of those are existing. So let's see, back of the napkin math, what's 500? Well, 400 out of 4,400 would be about 10%. So yeah, we're maybe 10 to 12% new construction, you know, 85 to 90% existing. But, well, okay, sorry, that's closed sales. Well, let's do it justice. Let's go through the process. This one's interesting, guys. New construction, new listings. So builders listed 14% more homes on the market. So new construction, new listings rose 14%. Previously owned new listings actually fell 25.5%. So we really see a difference here. Yeah, we really see a difference here. The builders were able to get more product online. Weather's been cooperative. You know, land acquisition may have been going better, so we can get projects done and permitted and get the dirt to build stuff. I know there's still challenges around the 5 L's: lots, labor, lending, lumber, and laws. One more time: lots, labor, lending, lumber, and laws are still challenging for builders, but you know, I think they're doing pretty solid so far this year with new listings. Let's look at pendings. So signed contracts only down about 3.3% for new homes, down, as we've seen, about 21% for existing. So some interesting differences there. You know, let's just hop into absorption rates really quickly. I'm not so concerned about the change here. As you can see, all right, 11% versus 13, not a big difference, but I want us to focus on the level instead of the change. Let's look at the level. 5.2 month supply of new construction. This is a balanced market, a pretty balanced market, 5 to 6 months of supply. Here we have previously owned, you know, that also happens to have more affordable units in that segment. Of course, a much tighter market at about a month and a half of supply. So pretty interesting dynamics there. All right, let's get back into, let's just wrap up with a few updates on the economy. We talked about this, and actually, this is an interesting one. I want to show you guys this Strib article. We are not seeing a flood to the suburbs. So NAR did some good surveying. They asked the question, have your clients changed their neighborhood preferences due to COVID? You know, almost 95% responded that there's been no change in the search criteria. You know, everything's kind of the same. 5% did report, yes, there's been a slight move away from cities or downtowns into suburbs. Remember, some of this was happening anyway as millennial households grow, sometimes outgrow their condo or townhome or even their small single family in one of the core cities. So, you know, some of this was a trend that's already been in play. And actually another 1% said, heck, yeah, I'm ready to give up my large lot suburban home and I'm looking for more of city or urban living. So interesting patterns there. Oops, just trying to be a little bit of a mind reader. You know, how will this impact home prices? The short answer, we don't know and nobody does, but the longer answer is it depends on the three things that we've discussed. So Dr. Yoon, chief economist of NAR, I like to quote him sometimes. I even show some of his slides and I always cite him. You have to. More temporary interruptions to home sales are likely, right? That should be expected in the next couple of months. However, they're not forecasting home prices to soften. Lauren says home prices will likely still rise. And so much of that has to do with the supply-demand balance, or I should say the imbalance. So in 2020, we are undersupplied. So that should bode well for, you know, to kind of minimize the impact from the economy on home prices. What was the picture back in 2008? We were oversupplied. So you could argue that we were already due for a correction back in 2008, even before the collapse of Lehman and you know, the whole Great Recession that came with it. So we're in a very different situation, and I think that's important to note. Okay, I'm going to rush through just a few more because I want to leave time for some questions, but there's just a few I want to cover. Unprecedented use of the word unprecedented. I thought that was kind of funny. So here, you guys, I use Google Trends sometimes just to see what people are searching for. We talked about getting a little bit earlier in the process. Well, guess what? Before I get a pre-approval letter, I'm Googling stuff. So let's look at the Google popularity of the search phrase, buy a house. Look at what we see. We see a nice increase in that search term. Pretty fascinating stuff. All right, here, well, excuse me, that was nationwide. How about in our metro? Now I'm looking at buy a house, get a mortgage, and open houses. So pretty interesting. We see a similar real nice jump in buy a house, people searching for buying a house. We see a little bit of stabilization, I suppose, maybe flatlining, but at fairly high levels for the search term get a mortgage. But this one's pretty fascinating. We've actually seen a decline in searches for open houses in our metro. It's hard to be certain. I cannot say this with 100% confidence, but it's fairly common, you know, to think it's fairly intuitive to think that the health situation has something to do with that. How about this? Is it safe to? Looks like that's come down a little bit. So I've kind of thrown that in, which I find pretty interesting. Okay, last couple, you guys, you know, just kind of looking at how the picture is going. You know, I'm not an immunologist, nor an epidemiologist, nor a virologist, but I am an analyst. I am a researcher. I do know how to interpret charts. So in blue, we've got tests per day. Testing is rising. That's a good thing. The only way to get ahead of this is to test. But look on the right axis with our red trend line, percent positive. So this is fairly encouraging. Again, I cannot say we're out of the woods. Nobody can. But, you know, over 20% positive results versus now a little bit closer to 5%. Maybe there's some evidence that's flattening out. Maybe we'll see a second wave. Really hard to say. So look at the year-on-year change in open table reservations, just to kind of show you guys how things are opening up. Of course, things vary dramatically by state, with our friends down in Texas leading the way. You know, versus New York is barely out of this. California barely showing any gains in open table reservations, but Georgia as well. So obviously the states that have reopened are showing more movement. Hotel occupancy in red, it was on track with this long-term average in blue until it wasn't. And now we are seeing things back on track a little bit. Another interesting data point, TSA checkpoints. Here's 2019 in blue versus 2020 in red. We really saw TSA checkpoints decline quite significantly. We are seeing a little bit of an uptick there as well. Even gasoline consumption, right, down sharply, but a decent recovery since. You know, let's skip sentiment for now, just in the interest of time. Look at the purchase index, you guys. This is national from the Mortgage Bankers Association. I think this is so important. This is the purchase index, not refinance. So I know there's a lot of refi activity with these low rates. This is the purchase index, pretty much all the way back here. So again, we get a pre-approval letter, then we go to a showing, then we write an offer, then we close a deal. We are trying to get as far ahead of the picture as we possibly can. Another way to say this is a V-shape. I'm not convinced the economic recovery will be V-shaped. I still think it'll be a swoosh, but this is really encouraging that mortgage applications are effectively all the way back. So I think that's pretty important. Okay, I suppose because we're just about at time, I want to open it up a little bit, unless I've got one more. Oh, you know what? I guess I've got just one more to show you guys. Look at the unemployment rate by state. Here's the US average. Here's Nevada, right? That relies so much on leisure and hospitality on the Strip. Look at Minnesota. Look at how well positioned we are, you guys, in terms of unemployment rate. We're, based on this metric, we truly are above average, or I suppose below average. Another way to look at it, look at unemployment rate by state, 8.1. We are doing remarkably well. In fact, as we just saw, better than any state outside of Connecticut. Here we see Nevada, again, pretty hard hit. All right, I think that's just about it. I know I've got some others. Maybe the last one. Even though we saw the personal savings rate jump, it's because people are spending less. And let me conclude with this. Housing is rebounding really well. This is one of my favorite economists, Dr. Eisenberg. Home prices continue to rise pretty solidly. He thinks new home sales will probably bottomed out in March. And he also notes first-time mortgage applications are up fairly notably. So he's saying, housing is a bright spot, but housing may not lead us out of the recession. That seems to be still dependent on COVID. I want to say thank you, and should we open it up to any questions? Let's let's check the chat here, Ann.
Yeah, I'm looking. I'm not seeing any questions at the moment.
All right, I'll take that as a positive. I will say I want to thank you for joining us today. Thanks so much for spending some of your afternoon with us. I want to again also say thanks to Supra, Royal Credit Union, North Star, and Bell Bank. And I want to encourage you again, shameless plug, please do come back next week. I really appreciate you guys being here. As you know, registration is required, so please do that. And I already gave a plug for my colleague Eric's webinar, Mondays at 1 p.m. He really does a nice job discussing the policy changes at all levels, so do check that out. Other than that, feel free to reach out to any of us with any questions, and have a wonderful day.